Hello and welcome to Cafe Mutual YouTube channel. Friends, we all know that the AUM of the mutual fund industry has reached close to 69 lakh crore in December 2024. A healthy portion of it, or 16% of it, has come from passive funds. In terms of folio, passive funds now account for 3.89 crore folios. Clearly, the traction of passive funds have been growing by leaps and bounds. To discuss more about passive funds and opportunities for MFDs and investors in passive funds, today we have invited Arun Sundaresan, Head-ETF Nippon India Mutual Fund. Arun has over 2 decades of experience in product sales and distribution. So Arun has been instrumental in developing passive business for Nippon India Mutual Fund. So let's welcome Arun. Good morning, Arun.
Hi, Nishant. Thanks for having me on the show. Thanks.
Thank you, Arun. So, Arun, my first question to you is that the AUM of passive fund, as you know, has been increasing very substantially over the last 1 year. So, in fact, in the last 1 year, its assets grown by 30%. And in terms of folio, it is now account for 17% of the total industry folio. So, what are the three things that has contributed to this massive growth?
So, as you rightly pointed out, whether it is in terms of AUM or folios or net flows across passive categories, that is both in ETF and index funds, across categories in equity funds, in gold, silver, to some extent in fixed income. Across categories, we are seeing increased interest, which is what is getting reflected in the numbers. As you mentioned, both in terms of AUM as well as in terms of folios, roughly it accounts for 17%. So you can say that one sixth roughly or one fifth of all the action that is happening in the mutual fund space is actually happening in the passive space now. And the rate of growth is also higher than in general when compared to the other parts of the market. Now, what could explain this kind of interest, especially over the last 4 or 5 years? Passive is a relatively new phenomena as far as India is concerned, but people are noticing the interest is going up. Generally, two reasons are cited for the popularity of passives globally, and I will also cite one more reason beyond them. So, number one is this that there is a lot of data and a lot of reports to suggest that the active funds, it's very difficult to generate alpha or for funds to consistently beat the index. There might be a fund which could be outperforming the markets or benchmark, but in the very next year it could underperform. And it's a big deal to identify which fund is going to do well consistently, etc. So this ability or inability of active funds to outperform the markets is something that investors take note. And the second point is, which is related to the first, coupled with this, is the cost. So if the funds are not going to beat the benchmark, why pay a higher cost? Rather, would you not take market exposure through passives, through index funds and ETFs? So these are two primary reasons why globally passives have become very large. In fact, in the US, the passive AUM is today larger than active AUM. So these, and again, it's happening in different markets, including in the developing markets. The other important point is this may not be very well noted or appreciated. In a way, passives are the truest, true to label kind of products. So when you say, for example, a mid cap index fund, you will that fund will invest 100% in mid cap. So it will not invest into a bit of large cap, small cap, cash. So the entire money gets invested into that particular part of the market, that particular index. The same goes for sector. You say a bank sector fund, 100% into banks. It doesn't get mixed up with even financial services, leave alone any other part of the market. So you get very pure exposure. So somebody who wanting to have, let's say, a pure large cap exposure or mid cap or sector thematic or even those smart beta kind of products, the passive products allow you to do that. That may not be the case in active. It will be slightly mixed bag, right? So that I would say is the third reason. And the last also is the fact that today in passives, a whole lot of innovative, differentiated offerings are available, which perhaps is not even available on the active side, especially the strategy indices or funds based on them called as smart beta funds. You have a whole variety of them, momentum, alpha, and combinations, alpha plus low vol, and whole lot of combinations across the market cap, be it on large cap, mid cap, small cap. So that makes the space very interesting, and a lot of distributors and investors are lapping up these kind of innovative, differentiated ideas, which can give them very different portfolios and unique risk return kind of profile.
So Arun, as you know that SEBI has recently come out with MF light regulation for new as well as existing players. So first of all, what is your view on this? Being a passive expert, I wanted to know your view. And secondly, are you as a fund house considering segregating your passive business under MF light regulations?
See, MF Light, the regulation which has come in the recent past, there are three parts to it. One is for new entrants, anyone who wants to come into the mutual fund business, the industry, they can take a MF Light license, and the requirements for the sponsor, the compliance requirements, etc., are quite light when compared to what would be applicable otherwise. So it makes the entry for a lot of new players that much more easy. So somebody wanting to run only passives, given that these products are simple products, it is not as complicated as some of the other, even within mutual funds. So that is kind of getting facilitated. So that's one of the major developments as far as MF Lite is concerned. Now, for existing players like us, there is also an option that the AMC can hive off certain type of passive schemes, and they could be run differently, and the regulations required, the compliance requirements for them would be very different, and so on and so forth. That option exists, but whether we are considering that or what exactly we will do is something that we are currently evaluating. I'll not be able to comment on that, but it does open up a few possibilities for new players to potentially come in, and also for existing players to run their businesses differently. The passive part can be hived off and run differently. So it does make it interesting.
So are you considering segregating your active and passive business under the light regulation?
No, we are evaluating. Too early for me to comment on that. Of course, all options are open to not only us, to all the other AMCs as well. But that's something it's too early for me to comment on. What exactly we will be doing.
So Arun, since 2015, Nippon India AMC started focusing on passives by acquiring Goldman Sachs Mutual Fund. Now the fund house manages, 1.65 lakh crore of assets only through passive schemes. So how has been the journey so far, and what are your learnings from the passive funds so far?
So our management team and the leadership team, they've been early to identify the potential in passives. Therefore, amongst many things, even prior to that, we did have passive schemes, but we also chose a inorganic route whereby we acquired the assets of Goldman Sachs, and prior to that, this was Benchmark. So they specialized in the passives, and some of the schemes had a good track record, and they were quite popular. So to that extent, the team identified the potential and the opportunity in the passive space, and we made that decision. This was way back in 2015, and at that point in time, the passive AUM overall in the industry itself was very, very low. In fact, today, you mentioned that passives account for 16, 17% of the AUM. At that point in time, it was hardly anything, 1.5%. And when we took over the assets, it was only 6,000 odd crores, 6,600 crores or around that. But since then, the investor interest has gone up across the type of investors. You have large institutional investors, family offices, even individual investors coming into the passive for various reasons that we discussed. And the AUMs overall have grown. And so has our own AUM from 6,600 crores way back then to 1.65 lakh crore. And today we are having 1.46 crore folios only in passive. We have 48 different schemes across equity, fixed income, commodities. So it's been a phenomenal journey, so to say, in terms of how the growth has happened across parameters. At the same time, the experience has been quite good. A lot of people, even some of our partners, they think of the passive schemes and they try to pit it against active, active versus passive, which is better and what should I do and so on and so forth. Our experience has been that passive is actually complement. Like, for example, you may have certain innovative or a very differentiated idea in passive that may not be in active, or for that matter, there will be certain type of investors who perhaps could be inclined more towards passive. So these kind of products, when our own sales teams go and meet our investors, it gives a better entry point. When you go with a complete bouquet of products, across active, passive, and where again within them you have multiple different offerings, that makes the experience for everyone very good, and therefore it helps. So to that extent, it's been quite useful and enlightening. The journey has been quite eventful for us.
So Arun, Nippon India has recently launched a campaign called Massive in Passive. So can you tell us more about this campaign?
So we're fairly large when it comes to the passive space, as you pointed out. We're managing currently 1.65 lakh crore assets under management. The number of folios out of total folios in the passive, nearly one third of all the folios would be with Nippon. Currently have close to about 1.46 crore folios. On the ETFs, where volumes are paramount, it has a direct impact on your returns. So there we command, depending on the scheme, in general, almost around 55% of the volumes. So that makes the schemes relatively more efficient in terms of reduced spread, and therefore it has a direct bearing for investor returns. So there again, schemes are fairly good. We have a total of 48 schemes. This is across ETF, index, and the fund of fund, the passive fund of funds. And this is again spread across equity, fixed income, commodities. Within equities, you have the broad-based markets like Nifty, mid cap, small cap. Then you also have sector, thematic, and many smart beta strategies as well. So this campaign is to, in a way, celebrate, to also point out to our stakeholders about our standing as far as passives is concerned, to draw their attention to the fact that passive itself is very big, and within that we are fairly large and we are massive, and to very clearly put out that, look, this is what we are managing, so that it gets the attention of the different stakeholders. So that's the campaign all about, where we are putting this out in print, in newspapers, in media, in a lot of the digital channels, etc., to create the visibility and the awareness about our own position when it comes to passives.
So Arun, in the campaign, Nippon India AMC has mentioned about trading volume in ETFs. So you have 55% of that. So can you throw some more light on this aspect?
So, as far as ETFs are concerned, volume is perhaps one of the most important metric. I would say probably even more important than the expense ratio. So what happens is that when the volume is good, it's like the same concept as in stock market, right? When a stock is large and liquid, it gets traded quite regularly. It tends to trade very efficiently. The prices will be close to what gets displayed. You will have less spread. You will be able to buy and sell at lower bid ask. Right? It's the same concept that applies to ETF, a particular ETF which has good volumes, which means that there are enough number of buyers and sellers at any point in time. So the transaction will happen close to the NAV. the actual NAV. On the other hand, if the ETF is not liquid, if the volume is not good, then the investors will pay higher spread, which is a direct cost, where the current NAV is X. You will end up paying more than that when you buy. You will when you sell, you will get far lesser price when you sell. So to that extent, the volume is a important metric. And today we command roughly 55%. So more than half of the volume that happens in ETF actually happens with the Nippon schemes. So that is a very important metric.
Okay. So Arun, one more aspect with ETF is impact cost. So how do you ensure that the impact cost of your ETFs remains low?
Yeah. So the impact cost is directly related to the volume. The higher the volume, lesser will be the impact cost. Obviously, this volume, which is the natural liquidity that happens when investors transact, that would, in a way, result in lower impact cost. Of course, the ETF ecosystem also has this mechanism called market making mechanism, whereby authorized participants, or who they are called as market makers, they come in and provide liquidity. So you're trying to sell, but there is no buyer. The market maker will give you a quote for buying, and vice versa. And we'll try to get the liquidity going. But obviously, this will come at a cost. It will come at a spread. So market making activity also, the more the liquid, the more the volumes, the more the action that happens in a particular ETF, there will be more market makers, and market making activity also, they'll be keen to do that. On the other hand, if there are a set of ETFs where as such there is no volume, the market makers also may not be active there. So both this natural liquidity and the market makers coming in and providing that liquidity in those ETFs where there is a lot of volumes and business to be made, those in turn, result in lower impact costs for investors.
Okay. So Arun, many distributors are yet to integrate passives in their business. So what is your message to them?
So passives. So within passives, let me pick out a subcategory, index, and within that, let's say equity index. Now, equity index fund net flows, the net sales that has happened in this financial year for the last 9 months, starting from April till December, is roughly about 54,000 crore. So we are talking about roughly 6,000 crores of monthly net sales that is happening. And please keep in mind that unlike active funds, the SIP book in index is a reasonably a new concept. Therefore, it is not very high. A little over 1,000 crores is the SIP book. So if you leave out even SIP, nearly 5,000 crores of net flows, fresh flows is coming in every month. So that makes this amongst the topmost categories in terms of net flows. So whether we like it or not, this is a category which is attracting a lot of new flows. So that's something that if you're absent in that segment, investors are investing, they are interested. So we will be missing out. So that's something that we need to keep in mind. The second thing is, and my request to our MFT partners is this, that index investing or passive investing doesn't mean just boring, just replicating a market, and there is no fun, there is no value addition that MFT is making to their clients. The answer is no. There are a variety of passive products. In fact, some of them have risk return profiles which are very different and very aggressive than when compared to active funds. To pick and choose those kind of funds, what will be relevant at various points in time, there can be tremendous value addition that can be done through passives also. So therefore, both given the fact that this is a fast growing category, there is a lot of investor interest, as well as the fact that it offers a lot of interesting opportunities for you to recommend to your clients, and create unique risk return profiles. The portfolios can be very, very differentiated. I think passives make for a very strong case.
Okay. So one last question, Arun. So how can MFDs shortlist passive funds for their clients?
So very simple. Passives come in different categories. Like, for example, equity, you have broad-based markets like Nifty, small cap. Then you have sector like bank, pharma. You have thematic like infrastructure, manufacturing. Then you have all these strategy funds or smart beta funds like alpha, low vol, momentum, quality, value, and so on and so forth. So within categories, selection is relatively easy. Unlike even active. So, for example, we want to play the large cap part of the market. In the passive, you select Nifty 50 or the Nifty Next 50. Unlike active, where you also have an additional element where you'll have to assess the fund manager style, etc. That's not there. So it becomes easy, right? So then, depending on investor risk return, should you give large cap, mid cap, or any sector theme? All of those things can be done, right? That's broadly. But if you want to select within a category which fund house or which fund, specific fund to choose, there we had recently come out with a campaign called as Victor for ETFs, particularly. Victor stands for VICTER. It's an acronym of volume, V for volume. Higher the volume, the better. IC is impact cost. We just spoke about it. Lesser the impact cost, it's better. Then T is tracking error. The lower the tracking error, the better. And expense ratio. So you can consider these four data points. All these data points are available. As far as index funds are concerned, you will volumes and other things don't matter. For that matter, impact cost and other concepts are not relevant. But you may still want to see the AUM, the size of the fund. You may also want to check things like tracking difference, tracking error, etc., which is nothing but how's the fund performing vis-a-vis the benchmark. Ultimately, you'll have to check the benchmark. The return should be closer to the benchmark. So tracking difference is one of the important metric that you may want to consider. And some fund, having reasonable size. One should not go for very small funds, and so to that extent, if they can take care, I think the selection also would be relatively easy.
Okay. So with that, we have come to an end to this interesting session. Thank you so much, Arun, for your valuable time and inputs.
Thank you very much.
And finally, I thank each one of you for being such a wonderful audience. Have a lovely day at work, guys. Bye.